Hey, Bowtie Nation, Joseph Hogue here. Thank you again for joining us for another one of these Beer Money Sundays. I've actually got coffee today. Got up early to get my workout in. I've got beer, but later on for today to enjoy with the family. So, doing coffee today. But wherever you're at in the nation, you enjoy your adult beverage or otherwise. And again, thank you for being here. Love these weekly chats. Just kind of a way for me to take off the tie and relax and talk with you out there in the Bowtie Nation. Great video for you this week. Probably the most important topic in the stock market today. Okay, inflation, interest rates, whether it's going to be a problem for stocks now, for the rest of the year, or even into next year. And I'll be honest with you, folks, this has surprised me. It really has, because so far, inflation doesn't seem, and interest rates don't seem to be a problem for stocks. We had that big sell-off in February and March where the NASDAQ was down about 10-15%. A lot of those high growth stocks were down, 20-30% and more. But they've since rebounded. Obviously, we had some sell-off in the last week, but interest rates really didn't go up, and we've seen a huge push to inflation higher, and yet it really hasn't derailed the market or some of the returns that we're seeing. But what about in the future? Ray Dalio, billionaire bond manager Jeffrey Gundlach, they're all saying that yes, there's going to be inflation. Inflation is going to eat away at stocks, and interest rates are going to do the same. We'll talk about that, but really, where's the market proof, right? So I want to get started. Again, I love seeing everybody here in the chat, the Bowtie Nation there. See everybody coming through. Chile, Somalia, Canada. Love seeing where everybody's coming to us from. So let's get started here. I do want to invite everyone to sign up for the Daily Bowtie. It's an absolutely free daily market newsletter that I put out. Comes out at 9 p.m. each night before the market opens. Gives you all the stock market news, the trends, strategies, things I'm watching really for not just the next day, but for the next couple of weeks. I pinned that link up in the chat above. Click through. Again, it's totally free. Just something I like to do for all you out there in the nation. But let's get to this because, again, it is I think this is probably one of the biggest questions the market has right now. And how that goes, what the answer to that is going to determine whether stocks are higher for the rest of the year, lower. And ultimately, I think, this is probably going to be the thing that pushes us into that eventual stock market crash. Not saying that it happens this year. In fact, I don't think it's going to happen this year. That doesn't mean you can't get a big, 10-15% sell-off like we did in March and some real pain in some of those portfolios. But I don't think we're going to get an actual crash of, 20-30% this year. I think that happens, maybe next year, maybe the year after, as the Fed does start to hike those interest rates, and as we do start to see this inflation really heat up more than anyone has expected. So let's get started. Just a real quick call out. If you haven't seen last week's videos, we did kind of a stock comparison video Friday between a $5 and a $500 stock. So I know a lot of you out there, you're looking for those inexpensive stocks. You can get as many of them as possible. And really, definitely a video you want to check out because it shows you not only that 7-step process to compare stocks, but also that, those low price stocks might not be the best pick. That's not always the best pick, actually, in our $5 versus $500 stock. The $500 stock actually came out the better pick, I think, the better investment. Next week, got some stocks for risk takers, right? Did a group of stocks, looked for some risky stocks, high risk, high return kind of stocks. So I'm going to do that on Wednesday, as well as some safe monthly dividends, right? Been doing a lot of monthly dividend stocks lately. You seem to like it, so I'm going to be doing different themes in dividend stocks and show you how to do those. So let's get to this idea, right? And why the market really isn't reacting to inflation, where we're at right now, and what we can see for the rest of the year. So we've got pretty modest inflation. Why inflation can be a problem is that modest inflation between 2 to 3%, not too bad. It helps borrowers, right? Because they're then paying loans off with cheaper dollars. And it doesn't destroy the savers, right? And it helps push those asset prices up, okay? Basically inflation's more money in the system. It's worth a little bit less each year, 2 to 3% each year. It's not a problem. So obviously, just prices get pushed up. That helps asset prices. It helps borrowers, and it doesn't destroy savers. Now the problem is when it goes above that, 3%, 4%, 5%, when that inflation rate starts heading higher. And especially when people's expectations of that are higher. A lot of times you're going to hear it in the news, and you're going to hear that it's not really inflation that counts, but expectations, okay? And that's really a big reason why it's not hurting stocks right now, okay, is those expectations are that, yes, inflation is a little bit higher right now, but it's only temporary, and it's going to come down. And a lot of people believe in that. The Fed's preaching that message. A lot of economists are preaching that. I'm doubtful though, and I'm going to tell you why. I'm going to show you why here in a little bit. But once you get those expectations for higher inflation above 3%, once you start seeing those numbers, it starts to be a problem, right? Because anyone saving, anyone living off a fixed income, their money is destroyed. If you lose 5% of the value of your dollar, of your purchasing power each year. 1 year it's not so bad. You could still buy 95% of the stuff you could buy with those dollars that you saved. And a lot of times we're talking about retirees, people with living off their savings, living off of a fixed income payments. If you've got that bond payment coming in twice a year that you're using that to pay your bills, that's fixed. That's not going up with inflation. So it gets, the purchasing power of that is down each year. And 5%, loss 1 year isn't too bad. But when you start stacking it up over, over 5 and 10 years, especially even shorter terms, 3-5 years, that's a big hit to your purchasing power. So savers are destroyed. Corporate earnings also tend to be lower with that higher inflation because companies just can't pass on all those expenses. Right? If inflation goes up, wages are going up. That's something we're going to talk about because it's a big part of what we're seeing right now is that wage pressure and that wage inflation. But also a lot of their input costs are going up, right? Well, some companies don't have as much pricing power. They're afraid there's too much competition in their industry. If they start raising those prices to cover all their costs, all that inflation, customers are going to bail. They'll just buy less. So profits tend to be lower, and of course, profits are the ultimate value in stocks. And if profits are lower, then stocks tend to go lower as well. All this also pulls the interest rates up, right? If inflation goes up, then, if inflation on the dollar goes up, people are going to demand a higher interest rate off dollar-denominated bonds, off of treasuries, right? So that pushes interest rates up. And obviously, as we saw back in February and March, that becomes a big problem for those tech stocks, for those growth stocks, right? Any stocks with the majority of their cash flows out into the future, those higher interest rates are a big problem because how you value stocks is that discounted cash flows formula where you take an interest rate and you take each year of cash flows that you're expecting from that stock and you discount it to a present value to find how much that stock is worth, right? So if that interest rate goes up, then you're discounting those future cash flows by more and more a higher amount, which means a lower present value, okay? So, right now where we're at with inflation is everything is pointing to higher inflation. Okay, we had the consumer price index, the CPI, out last month. It was a 5% highest in decades. And that's just the consumer, the year-over-year price inflation on a basket of goods that most consumers buy. Right, 5% higher than it has been in decades. The producer prices actually just got released about a week ago or so. And that was the highest annual increase on record. I think the CPI was highest in since 1982 or something. The PPI, and so consumer price index, CPI is consumers, obviously. Producer price index is going to be that, what producers are paying, what they're paying for those raw materials, what they're paying for their supplies. And it's a great indication of, future consumer price inflation, right? Because if producers, if manufacturers and everybody that makes stuff is paying higher prices, they're going to try to pass those costs on to consumers, right? So highest annual increase on record for the producer price index just about a week ago. Even the Fed, the Federal Reserve, Jerome Powell, Chair Powell, has been talking down inflation, saying it's only temporary, it's not going to be a big deal, trying to calm investors down a little bit. Even the Fed had to update its inflation estimate for this year. When it met Tuesday and Wednesday, did its statement on last Wednesday, they increased their expectation for inflation a full percent to 3.4% for this year. Okay, they're still sticking to that line that longer term inflation is still going to be 2%, right? They're sticking that to that target. And why this is important is because 2% is the Fed's inflation target. Okay, the Federal Reserve, Central Bank of America, and central banks all over the world, they target an inflation rate usually and a jobs rate, an unemployment rate. Right? It's got a dual mandate, and it uses those dual mandates to kind of play with interest rates. Right? If there's really high unemployment and they want to get people back to work, they want to boost the economy, they'll lower interest rates, right? So the cost of money is interest rate. How much people pay for that money, the interest rate is, and try to boost the economy with those lower rates. Well, what happens is, and that's what we saw obviously last year, right? They lowered interest rates down to zero, basically. So basically free money for whoever can borrow it at the Fed funds rate. And they're just trying to push out as much money as possible. They're also doing a lot of stimulus, right? The Federal Reserve, is buying $120 billion worth of bonds every month. And when they buy bonds, they push cash out. They pay cash for it. They push that out into the system, okay? So this is a way of spurring the economy, spurring economic growth, and so back to those dual mandates that the Fed has. It's supposed to keep pricing pressures under control, right? Central banks, they can push all the money out in the economy they want, but if it destroys the value of that money, then obviously they're not doing a good job. Okay, then obviously you've got a problem. So not only do they want low unemployment, they also have to have low inflation, right? So it's kind of a trade-off. It's kind of a trade-off between, how much employment can we get, how much unemployment we can get down, but still keep inflation, inflation in control, right? And so the Fed's target is 2% on that long-term inflation. It doesn't want to see prices or inflation go up more than about 2%. And, inflation has been very low over the past couple of years, over the past decade, really. And so the Fed has started to say, you know what, we've been trying to, we've been pushing all this money out in the system. It's not really resulted in much inflation. So we're going to say, hey, we're going to let inflation go a little bit hotter than that over the short term. We're going to let inflation go, 2, maybe even 3% or higher. They haven't said how high they would allow it to be because they don't want to, tell the market too much, tip their hand too much to the market. But that base case is 2%. They're saying they can let it go a little bit higher. And so what's important here is that as we do see the Fed see inflation get higher, then it becomes a problem, right? Because eventually the Fed's going to have to say, okay, you know what? Unemployment's coming down. We're getting some good jobs numbers, but inflation's getting up. So we have to start taking away some of this stimulus. We have to start raising interest rates. We have to stop buying so much bonds every single month and pushing this money out in the system because it's becoming too much for inflation. Okay. Again, the reason why the market doesn't really care too much about this right now, about all that inflation, 5% year-over-year consumer price inflation last month, and I think that's going to be higher over the coming months. But gold, the ultimate inflation hedge, up 13% in the second quarter, and that's April through mid-June, plunged 4% on Thursday. It had a big jump on Wednesday when the Fed actually started talking about inflation, raised its inflation estimate, but then came right back down on Thursday and really crashed. Rates also, again, rates and inflation are very much tied together because higher inflation is going to push interest rates up. Jumped about 4% on Wednesday to about I think it was like 1.55% back, but then 1.6%. But then on Thursday, it crashed back down further, crashed back down to like 1.45, 1.5, something like that, which obviously is way under the 1.75% where it peaked at in late March. Okay. Interest rates, this is the 10-year Treasury bond, right? It's what most people talk about in the market when they're talking about interest rates. That's kind of the base interest rates. So 10-year yield started at like 0.9%, right? So less than 1% in December, okay? December, January of this year, and then surged in January, February, even into March, up to 1.75%, which, 1.75% from 1% doesn't sound like that big of a change, but for interest rates, it is huge, right? For bond rates, that is a huge move, almost double, basically, right? So, and that's really where we saw that first semi crash, okay, in February, March, when tech stocks, when growth stocks were really crashing. That's why, because those interest rates were going up so high. And really, what's happening here is the stock market, investors as a whole, really believing the Fed when it says that they think the lower long-term rate story, okay, the long-term interest rate story. Um, the Fed is basically saying, yes, okay, we're getting inflation now. We upped our estimate for 2020 to 3.4%. Consumer price inflation, highest in decades. Producer prices, highest growth on record. But, once we get out of this and we stop pushing so much money into the system and all these blah, 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 inflation's not going to be a problem, right? No big deal. I mean, the thing is, I'm just always tend to be a little bit skeptical about the Fed and what it does. They do a lot right. And God help us, we needed all that stimulus money last year to really keep us out of a depression. And the Fed did a good job lowering interest rates and all that. But if you look at nearly every single stock market crash, going back all the way back to the 1907, all the way back, just about every crash, the Fed has something to do with it, and a lot of times it's just keeping those rates too low. Back in 2000, with the internet bubble, when the Fed lowered its rates, I mean, it took them till like 2003 to start raising rates. And by then it was too late. Stocks kept on going because the rates were so low and kept so low for so long that it just caused that bubble. Again, in 2008. That was really because of free money and all the money that was going into mortgages and all that kind of stuff. And that's the same thing. If you look back in history, I mean, a lot of those stock market crashes are caused because the Fed just doesn't want to raise interest rates, right? It slows down the economy, and even though it's independent, it's not political. Then they're kind of they get pressure by the politicians, by the president, by the politicians. They get a lot of pressure when they start raising those interest rates. So they tend to keep rates too low for a long time, and for those that are saying that inflation is just going to be temporary and it's not going to be a problem. I mean, granted, inflation has been historically low over the past 10 years, but it's just impossible to think how you can increase the amount of money in the system by 26%. That's how much money, how much cash was pushed out into the system last year with all the stimulus, the Fed stimulus, the fiscal stimulus from the government, lower rates, all that. 26%, the amount of money in the system increased. And versus the average each year is about 5.8%, right? All the way back to, I think it's like 1994. I looked at the amount of the money increase in the system is about 6% annually, okay? 26% last year, we increased it. And yeah, we didn't get a whole lot of inflation because people weren't spending it. Okay, you need two things for inflation, right? You need the amount of money to increase, but then you need that velocity of money, right? You need need that money spent over and over again, right? And we just didn't get that, so that's why we didn't get inflation then. But as we're seeing, inflation is coming. Inflation is here for the consumers, for producers. Companies are already saying they're raising prices, and wage inflation, I think, is going to be a big part of this, a big factor. We're seeing people quit their jobs at a record rate. We're seeing people quit their jobs because they can go out and get a higher wage job, right? And they're pushing that up. So I think that's going to be one of the largest factors in that longer term inflation, okay? Because you can raise your prices temporarily, right? And you can bring them back down once your own input costs come down a little bit. But how do you reduce people's wages? All these companies hiring people back and all that. How do you tell somebody that, okay, you know what, it's a competitive environment, we're having to pay more, we're going to start you off at 15 or 20 bucks an hour, okay, 25 bucks an hour, whatever it may be. How do you 6 months down the road, a year down the road, you say, okay, you know what, we have to cut your wages. Those people are gone, and they're going somewhere else where they're still offering those higher wages. So wage inflation is really going to be a factor. It's not something that we've seen in the data yet, which is why I think this becomes a much bigger problem than we've seen it. Okay, we've already seen a lot of those other wage pressures pushing the consumer prices up. Now we're going to see wage pressure on top of that. And yeah, you know what? It's a great thing that people are making more money. Good for them, right? But when you're talking about inflation and its effect on the market, then that's where it becomes a problem. I don't care how much people make; they make all the money you can make. But when I'm thinking about how I'm going to invest, then I got to think about, okay, what's that doing to the economy, to corporate earnings, and that kind of thing. So that's really where we're at now. So then when you're looking at this, what do you do when you're looking at your investments? So there's really four things that I'm kind of looking at as far as inflation protection. We did a video on this about a month ago or so. Obviously, gold is something that everybody runs to when they're trying to protect their assets against inflation. And I liked it up to 1850. It recently broke out past that to about 1900 and then came back down again. The reason why I still don't like gold quite as much as some of these other inflation hedges, though, is because interest rates, right? As interest rates go up, and eventually, as we get higher inflation, interest rates are going to go up. Then that tends to hold the price of gold down, and we can look at a chart, and you can see this the price of gold and how it really kind of stagnated. I kind of held in that range. I was looking at that range from 1700 to 1850. And so for those of you that in the nation out there, you know that I've been talking about gold, and that range that it's been trading in. And we'll see if it'll bring up this year-to-date chart. Okay, well, here's 1 year, and you can see. I mean, it's a matter of scale. It looks like it's jumped around quite a bit, but the bottom part of the scale is only 1700. The top part is only 2000. The August peak of 2000. But even so, if we go back to the year period here, bottom is right around 1677, 1700, and the top is 1950. And you can see it's, for the whole year, basically 6 months, it's traded right in that range, pretty much in the range from 1850 down to 1700. Okay. And yeah, it did break out when we thought we were going to get a little bit more inflation. It started broke out, past that 1850 range and started going higher and then just crashed, Thursday, Friday, really gave back all of those back down to 1763 an ounce. And so, I do like gold as an inflation hedge. I do think that it's going to be limited as interest rates go up. Right here, I think it's probably down towards the bottom of that range. Obviously, you got some real support here right around 1700 for the price of gold. So if you're investing in gold, if you want that as your inflation hedge, I think you can do that. I think obviously the gains here are limited because it's probably not going to get much above that 1900, 1950 at the most, and really range bound there. I like the gold miners a little bit better just because you're earning that dividend yield and that return. And as gold prices go up, miners tend to outperform, right? Because they've got that leverage, that corporate leverage, where they're using debt and all that to amplify those sales and returns. All right, so there's gold there. All you out there in the nation, I've become a big crypto believer over this past year, really starting to analyze it for that long-term investment rather than just the short-term ups and downs. It's really my highest confidence investment right now. Okay, so not only is crypto a fairly good inflation hedge, it's not a perfect inflation hedge. Obviously, it's obviously much more tied to some of the other things, the other factors that we're seeing in it, but it's still going to be some kind of an inflation hedge. Okay, Bitcoin itself is limited to about 21 million tokens. Some of the other coins aren't limited as far as their supply, but it still has that perception as an inflation hedge. Okay, and that's really the important thing here is that perception, what people think, of an investment and how they relate it to these different factors. Okay, so people still think of crypto as very much an inflation hedge, or that as one of the fundamental reasons to invest in it. So I think crypto is supported in an inflationary environment. Obviously, I'm investing in it because of much longer term and much more fundamental factors like just the usage, its growth as an asset class, the investment case from cash reserves for corporations, as well as the 401ks and other things. So yeah, like I said, I mean, I think crypto does well here in that inflationary environment, as well as just other those other factors. One thing that has kind of really surprised me actually is real estate. It's done really well over the past over the past three or 4 months, right? REITs, so real estate investment trusts, those real estate companies that trade like stocks, are at 14% in the second quarter versus just 7% on the S&P 500. Obviously, property does very well during inflation. Commercial property, residential property prices tend to go up with inflation, but a lot of these also with the commercial properties and those REITs, they've got an annual rent escalator. Okay, and inflation is built into that, right? So if inflation into these contracts, these lease contracts for this property, then they've got in there that rent goes up 2% a year plus whatever inflation is. Okay, so they've got that rent escalator that's going to protect them even further from inflation. So what I want to do here is talk about some of the different property types, and this is important because I think a lot of people, you talk about REITs, you talk about real estate, and you say, so is real estate going to do well? Well, real estate isn't just real estate, it's all these different property types, and you really have to know where these different property types are at in the economy and what they're benefiting from. So this is something I always like to look at. It's the investment performance by property sector. It's put out by the the NAREIT, National Association of REITs. You can find it on NAREIT.com, or just do a Google search for like investment performance by property sector NAREIT, and you'll find it there. But it shows, you can find this one column here, 2021 year to date, how each of these property sectors is doing. Okay, and so far year to date 2021, you can see the NAREIT index, the REIT index, has done 18%, which is pretty darn good for about half a year. I believe that's probably better than the S&P 500 right now. And the dividend yield is still 2.9%, right? So even though prices for those REITs have come up quite a bit, the dividend yield is still approaching about 3%, which is about double what stocks are, which is impressive. But again, you want to look at individual property sectors and property types for your investments, right? So what I'm thinking here is, you've got longer term property sectors that have those long-term fundamentals, those long-term factors that are going to be driving them up, and that's why maybe I own a few different sectors, property sectors. But then you've also got the ones that are going to do well in inflation. So if you're trying to really protect yourself from that inflation, then maybe you're looking at some other property sectors, right? One of the great long-term ones that I really like is this industrial property. You can see it's kind of a little underperformed this year so far. Industrial property has done 16.7% so far year to date. And when we talk about industrial, that's all the warehouses, the e-commerce warehouses, the stores, logistics, things like that. And so obviously this one did really well last year. As all of those other property sectors came down, people still needed to store all that e-commerce purchases somewhere, Amazon warehouses, stuff like that. So it did really well this year. Has underperformed a little bit this year, but 16% in 6 months is still pretty damn good. Office space is kind of interesting here. 15% so far this year, so it's underperformed the broader property market, the broader real estate market. And what we're seeing is that, people are getting back to the offices slowly and gradually, but they kind of don't want to. A lot of employers are having to force people to come back into the office, right? And I think this is going to be a long-term phenomenon. More and more people are going to be working from home. They've got the bug. They already know how easy it is and how much more convenient it is. So there's a lot of employers out there having a big problem. I think it was I want to say Morgan Stanley, like the CEO of Morgan Stanley last week, put out a letter to all employees, and it was a harsh one. It was a harsh letter. It said, "Hey, we're bringing the offices back. If you can go out to restaurants, if you can go out eating and seeing your friends, then you can come back into the office." Okay, so it was kind of a harsh wake up for employees there that we're opening the office. You better be here or be looking for something else. So the offices are having a real hard time bringing people back. So that's why that's kind of underperforming. And I don't know that I'd be a big buyer of office space right now, those office REITs, just because of that. I think the expectation is that we're going to get office space back up to rents, and it just clearly isn't happening. Retail has done really well. almost 32% so far this year. And obviously, you've got shopping centers, regional malls has done 51%. I think this still does well. I think retail still does well through the summer as we see people get out and start shopping, and we see those retail sales numbers really pop up. Longer term, it's a little bit more of a mixed picture, right? Because e-commerce is just growing. It grew by leaps and bounds last year, but it's a slow, gradual shift to e-commerce that is really hurting these shopping centers, the malls, things like that. Residential has done really well. Residential real estate, 24% so far this year. I think rent. I saw another news story just this week that said rent is now the highest in history. It's touched the high for the median rent. So obviously that's going to help these apartment buildings, manufactured rentals, things like that. So there's residential REITs, that looks like it's going to keep on doing well. Obviously, as interest rates go up, the cost of buying a home goes up, home prices are going up. So that's just really pushing people out of the housing market into apartments. So I think residential rents do well. They've got kind of that inflation escalation each year. As well as they're kind of shorter term. Apartment leases tend to be shorter term, 1 year or less even. So they really don't have to wait to raise those rent prices. A lot of commercial spaces, like we said, they might be on 10 or 15-year leases and have that inflation escalation built in, but they still have to wait, maybe 10 years, 5, 10, 20 years or more to really boost the prices up to the market rent if they haven't kept up. Some of these other ones, I really like healthcare this year. It's kind of made a fool out of me. It's only done 9.5%. So it's healthcare real estate has really underperformed so far. I still think, just thinking through that, a lot of those elective surgeries, the procedures, a lot of the high margin stuff that hospitals and services and doctors, a lot of the high margin stuff that they get paid for got cut off last year. It's still not back this year, fully. But we're going to start seeing that. And I think we start seeing healthcare come up. With healthcare, I think you've really got to distinguish it further into, the servicers, the hospitals, clinics, things like that. And then, the senior space as well. I think the senior space really got hit hard and is still holding that sector down. Self-storage. This is kind of an odd one, 26% increase so far year to date. I'm not a big fan of self-storage. Obviously, people are buying more stuff and storing it, but it's really hard to see the fundamentals driving that through. Timber, woodland REITs, 16.8%. And have done really well this year, about market perform, maybe a little bit under. But I think we're starting to see that, come down quite a bit as lumber prices come down. Lumber prices are down about 40% over the past month. Infrastructure is another one of my one of my favorite long-term ones. Okay, infrastructure and data centers. Okay, data centers has underperformed 5% so far this year, and it's because they did so well last year. Okay, data center REITs, data center real estate did so well last year because everyone was online. They needed to, that all that data has to go through somewhere. It has to go through those data centers. So it did really well last year. We're seeing kind of a pullback this year, but that's obviously one of those long-term trends that you want to be following in real estate. So that's really what you got to think about in the real estate, in that sector. If you're thinking about, okay, am I investing in this property sector because of a long-term factor, like you've got with that industrial space, you've got data centers, infrastructure, healthcare, or am I investing in it for an inflation protection? So you've got some of those other sectors that you want to look at specifically for inflation protection. Okay. I think there's also a real opportunity in some of the reflation stocks. We've been talking about a lot, especially in the daily Bowtie, our market newsletter, been talking about a lot about on the channel about these reflation stocks, the cyclical stocks sectors. And so the cyclical stock sectors and the reflation sectors. Reflation is just, inflation, the stocks and the sectors that tend to do well in an inflationary environment. And that's energy, materials, right? And those are both because commodity prices, right? Commodities like oil, copper, gold, it's all denominated in dollars, right? People buy all those commodities the world over in dollars. So when the price of the dollar falls, or when the value of the dollar falls because of inflation, then the prices of those commodities, because they hold that value, that goes up. So anyone digging that out of the ground, anyone producing those commodities, anyone, oil or other metals, those stocks tend to do really well. So energy and materials. Now cyclical stocks that tend to do well with reflation and with the economy, like financials, so banks, insurance companies, things like that, as well as industrials, your manufacturers, things like that. And so here we're thinking, obviously banks do really well when interest rates go up because they can now charge a higher interest rate on their loan. Again, they don't want super high inflation, but maybe a little bit higher, 3%, 4% is okay as those interest rates go up. And what we've seen just in the past month, those have really sold off, especially in the past week. Those were some of the hardest hit as the market looked at the Fed statement and said, you know what? Inflation's not going to be a problem. We trust the Fed. We're not worrying about inflation, that kind of thing. These reflation sectors really sold off hard. So I think that's probably a second opportunity to maybe look into those and really protect yourself against inflation. Now on this, I wouldn't abandon tech and that growth just yet. I think the market has a lot of momentum here and really isn't seeing the kind of inflation that would scare them into thinking inflation is going to go up. So I think maybe you've got at least another couple of weeks here or so where tech and growth probably outperform. Even the sell-off of last week when the S&P 500 fell quite a bit last week, the Nasdaq wasn't down quite as much. I think the Nasdaq was pretty much about flat. So I think. I think tech and growth still outperform a little bit for maybe another month or so at the most. But I think eventually, and especially if you're really watching this inflation story, I think you want to get back in those reflation stocks and the cyclical stocks, the sectors, right? So again, that's energy, materials, industrials, and financials. Okay, so shifting to those. Okay, now I want to turn it over to the question and answer session.